Welcome to Stock Informer for You. The noise in the market is loud, but we prefer to let the data do the talking. Today, we are breaking down one of the absolute giants of the Indian pharmaceutical sector, Aurobindo Pharma. Now, if you've been tracking this stock on the NSE, you know it's been on an incredible journey over the last year, gaining over 34% and hitting a 5-week high near 1,550 rupees. But just this week, a massive curveball hit the company. The USFDA slapped its subsidiary, Eugia Pharma, with an OAI or Official Action Indicated status on its Unit-3 facility. The stock immediately reacted, sliding over 5% in a single session down to the 1,400 rupees levels. So what does this mean for retail investors? Is this sudden dip a classic buy the fear, multi-bagger opportunity, or is it a regulatory trap? Let's look at the cold, hard data across the financials, the game-changing future triggers, and the core valuations. Commercial powerhouse and the product mix. To understand Aurobindo's true value, you have to look at its sheer volume leadership. This isn't just an Indian pharma company. It is a global export powerhouse. Over 80% of its revenues come from international markets. In the US, Aurobindo is consistently a top 3 generic player by total prescriptions dispensed. They have a massive pipeline of over 700 final approved ANDAs. Think of it like an assembly line. When old medicines face price drops, Aurobindo launches 10 to 15 new generic products every single quarter to protect its top line. But look at Europe. Europe has officially become Aurobindo's crown jewel, crossing the massive €1 billion annual revenue milestone. In the final quarter of the financial year, European sales skyrocketed by a jaw-dropping 30% year-on-year. This massive diversification is exactly what protects the company when the US market gets tough. The financial health check. Let's talk numbers. Aurobindo's latest full-year financial results show a highly stable engine. Consolidated revenue climbed 6.1% to 33,653 crore rupees. Net profit PAT held flat at 3,503 crore rupees, delivering an EPS of 62.6 rupees per share. And their gross margins are rock solid between 60% and 61%. Now, analysts did flag a slight drop in the Q4 EBITDA margin down to 20.3%. Why? Because they are facing higher power and utility costs. But here was the inside story. Those utility bills are high because Aurobindo is actively powering up massive new internal manufacturing plants, like their Kakinada Pen-G facility under the government's PLI scheme. And check out their balance sheet strength. Aurobindo is completely net debt-free. They are sitting on a massive net cash surplus of $317 million. That gives them the ultimate flexibility to acquire complex generic portfolios, like their upcoming deal with Lannett Company, without taking on risky leverage. The 3 future catalysts, the next wave. The real reason big institutions are watching Aurobindo isn't their standard generic pills. It's what comes next. Management is transitioning the company into high-barrier, lucrative sectors. There are 3 massive catalysts you need to watch. First, the Penicillin G plant. This mega project is already tracking ahead of schedule, running at over 80% capacity utilization. By manufacturing this critical raw material internally, Aurobindo completely cuts off reliance on expensive imports, which will act as a major structural booster for their margins. Second, TheraNym Biologics. This is their brand new ultra-modern contract manufacturing organization, CDMO. Validation batches are starting next year, and full commercial revenue kicks off in 2028. The huge news here? They have already locked in global pharma giant MSD Merck as an anchor client. Third, CuraTeq Biosimilars. Over $50 billion worth of global biologics are losing patent protection soon. Aurobindo's phase 3 trials for their complex biosimilars are hitting their primary goals. Management expects to have 7 to 8 biosimilars commercialized in Europe by 2030, carrying incredible gross margins of 65% to 75%. Valuation and the USFDA overhang. So where does the valuation stand right now? At the current market price, Aurobindo trades at a trailing PE of roughly 23 times to 24 times. Compared to the broader Indian pharma index average of 34 times, Aurobindo looks remarkably cheap. In fact, if we look ahead to next year's consensus, earnings projection of 77 rupees per share, the forward PE drops down to just 18.2 times. For a cash-rich, vertically integrated industry leader, that is a significant valuation discount. But we have to address the elephant in the room, the USFDA risk. Managing 29 global commercial facilities is an operational tightrope. This week's OAI tag on Eugia Unit-3 marks the second time a subsidiary plant has faced regulatory action recently. While management states there is zero immediate impact on day-to-day finances, any escalation into an official warning letter or import alert can delay new product approvals and cap the stock's near-term upside. The bottom line? Aurobindo Pharma is evolving from a basic pill maker into a complex biologics and CDMO powerhouse. If you believe management can smoothly resolve these USFDA compliance issues over the next few quarters, this current price dip presents a compelling valuation cushion. What are your thoughts on Aurobindo Pharma? Are you buying the dip at 1,400 rupees or are you waiting out the regulatory storm? Let me know in the comments below. Don't forget to like this video, subscribe to Stock Informer for you for more institutional grade market breakdowns and hit that notification bell. See you in the next video.